Hi, my name is Akash and founder of Jordan Sky. Today we are going to talk about pre and post fundraising compliances activities a founder needs to do before raising a funds and after raising a funds. So let's get started. Understanding the basics of fundraising. So there are various stages of fundraising. Okay, it starts from a pre-seed, seed, then series A, B, C, then there is an IPO stage, and then M&A or IPO stage. So what is a pre? So let's understand one by one in a brief. So pre-seed is basically the money which you raise from your friends or family during an ideation stage that you've got an idea and you want to raise money for that particular idea. This is not really an institutional or a structured way of raising funds, but this is just a start money which you get to get your idea kickstarted and running. Second is a seed stage. Now, this is basically an official fundraise which you do it from an institutional investors or an VCs or an angel investors. This is basically a money which is given for once the idea is validated and you want to this money to go to the next stage. Next, there are various series A, B, C, and the list goes on and on. This money is given by high institutional investors like Sequoia or very high network of people. This money will help you to expand to different locations, geographies, or if you want to hire an executive team within the organization. So this is basically a growth money which will help you to scale to maybe a fundraise next fundraising stage or will help you for an IPO stage. What will happen to your company when you raise the funds? So now when you start a company, the capital structures are basically you and your founders would have like 50-50% shares or 60-40% shares, whatever may be the terms and conditions between you and co-founder. Now, suppose one institutional investors or an angel investors invest money in you. Basically, what happens at that point of time is a dilution of shares. For example, suppose you've got 5,000 shares, your other co-founder has got 5,000 shares and you plan to issue 1,000 new shares to new incoming investors. At that point of time, your revised shareholding structure would be 1,000 shares to new investors, 5,000 shares founder one, 5,000 shares founder two. Now there are 11,000 shares. So the revised shareholding percentage would be something like 9% to new investors, and around 42% or 41% to the existing co-founders. So this will happen when you raise funds from investors. Basically, there would be a dilution of your shareholding. When is the right time to raise funds? The right time to raise funds would be something when you have established a minimum viable product and there is a customers who are willing to pay for your product or for your services, and you need this money for the growth basically or to reach out this kind of an customers. Why raise funds from an investors? So basically there are two ways you can run a business. One is a bootstrap model wherein you do not intend to raise money from an investors and you build your business from internal accruals or your own capital. The another way is reach out to investors, get the money from them, build the team, grow your businesses, give them a very handsome exit. Now, if you're planning to raise funds, basically the question comes to is why raise funds from an investors? So this will basically when you want to have an hyper growth in your startup, you need that money to maybe do digital marketing or reach out to right executive team member, hire out right people. That's where you need money. Okay, so that is basically the reason you should go to an investors and raise funds from them. When is the right time to raise funds? As I mentioned earlier, the right time would be when you've established a clear product market fit and you feel of confident that this money is required to scale your business ventures to a next step. Now, coming to the main agenda of this presentation is pre-funding checklist. So what are the pre-funding checklists a founder should be aware about? One is pitch deck. This is the most important thing. And the first thing which you're going to share to an investor is basically a pitch deck. So prepare and pitch deck which clearly articulate the vision of your company, what problem you're solving, how big is the market, how you're going to solve the problem, What is the valuation you're looking out for? Now, valuation is again a very subjective matter, but it is important that you have a good picture in your mind in terms of what is the valuation of your business. The number should not be very much absurd and should be really rational. Third is the demo. Now, you need to have the demo of your product in place, wherein within 5 minutes of your time, you should be in a position to explain your product or your services to the investors, because this is actual the live demo which will help them understand what you have actually built. Fourth and the most important thing is data room. Data room will help uh, you to structure what all informations about your businesses, finances, which you're going to share it to your investors. So you should be ready with the data room. So data room would include your financials data, taxes data, your agreements, your employer records, employee records, whatever documents are required to be investigated by the investors when they are investing money in you. Now, you've done all these things, you've raised funds, brilliant. Now let's understand what are the post fundraising compliances. First, necessary compliances or taxes. Now you need to ensure that all the necessary compliances, just like issuing shares to the incoming investors, filing out all the necessary ROC compliances, get in really good experts who understand all these complexities and try not to do it on yourself, because you will end up creating a lot more problems in the future when you do not hire a real experts. So ensure that you are doing your necessary compliances and your taxes filing. Second, and the most important thing is setting up a detailed plan of action. Now, this plan of action should be something which would help basically from an usage of the funds perspective. Now, you raise funds, how do you plan to utilize those funds at a correct places? At times, what we have seen is when a startup founder raise funds, they are flushed with money in their bank account. Now, they end up spending on non-priority activities as well. So it is important to identify what are the priority activities, and then if there is additional funds available, then should move to the non-priority activities. The final checks. So final checks is you need to prepare for a fundraising plans, which is be ready with your pitch deck, your demo, your data room. Be ready with your data room, which will have your financials data, non-financials data. Then you need to ensure that you are complying with the pre and the post fundraising compliances. And last but not the least would be prepare a plan of action for post the fundraise, which is basically how you plan to utilize those funds in the business. Now, how Jordan Sky can help, basically, if you want us to help you with complexities, right, from data room, preparing of pitch deck, we can assist you with that as well. Also, we can assist you with the fundraising if your startup is in a right domain as well. Thank you very much. That's it from today. Again, we'll come with the next more brilliant topics. Please like the video and share it with someone who may need it. Thank you.